In this video, we'll explore the concept of the stock value investment. So what does it consist of? The strategy behind this type of investment is to buy underevaluated shares in order to resell them once their price has reached back the original estimated market value. We'll try to find a company stock whose price significantly dropped while the estimate market price remains high. For example, you find a share that normally cost $1, but you're able to buy it at 50 cents. Now let's talk about diverse reasons which could cause companies' price to drop. A classic example is the result of some bad media reviews. Obviously, it will be essential for us to determine if the reason behind this price drop is superficial or will considerably wound the company on the long term. So after a bad review or following a negative media story, it could be a great opportunity for us to buy this stock while it's on discount. Another reason can be related to a company's sudden change of direction, an economical crisis, or it can also be in reaction to some fraud committed by some high-level officials. Therefore, even if the price is temporarily affected, it doesn't mean that the company itself became less profitable. That's why you can expect the price to slowly rise up while you benefit from the price discount. In this type of investment, if your timing is good, that you buy once the price reached its lowest, it's possible to make quite a lot of money since it can quickly rise back up. Although I need to point out that it can contain a certain level of risk. In some cases, after an important drop, some companies may never recover. That's why prior to buying those shares, a deep market assessment will be required. As an example, we'll take a look at KT. This stock is traded under the New York Stock Exchange, and it's part of the communication service sector. As we can see, this market has dropped considerably since the beginning of 2019. Although the average price always ranged between $14 and $18, due to the COVID-19 crisis, the price suddenly dropped to $8. But since then, we can see that in the previous month, the stock return increased by 40% and the share price by 12%. This is exactly the type of market that we are looking for. Now, more importantly, if we look at the estimates, this company could easily go back to $14. That still gives us a lot of range in order to make profit. Later in this training course, we'll talk about how to select the best stocks. I'll explain more precisely how to sum up and evaluate this information. But for now, I can tell you that this market to me shows a lot of potential, since even if the price dropped, the estimate value remained the same. Also, if we look at the future of this company, they are currently doing a lot of development in the 5G industry, which is likely to expand in the next few years. Now, if we look at this detailed graph, you can see that I bought shares at $7.84. Here, we have a sudden drop due to the COVID-19. Once it reached its bottom, the price quickly started to rise and will probably go back up to its market value very soon. At the moment, we see that I already gained 21.10% on this trade. So, this is the sum up of the concept of the stock value investment. The goal is to buy companies' shares while there is an important gap between the market price and the book value.